Hi there, everyone, and welcome to our end of May edition for OnTracked. I'm recording this as usual. Well, I'm recording this on the 29th of June. I've just got back from a week in Queenstown. Looks like we got lucky and snuck in between the travel bubble being open and closed. I'll touch more on that during this recording, but it was nice to do a little bit of traveling back in sunny but cold Noosa as we speak on the morning of the 29th. All the numbers, the news is up to date as at this time. And the reason we do that is just that this presentation comes out after the Care Investment Committee, which was held just over a week ago. So let's get into it. Firstly, general advice: this presentation is for clients of McGregor Wealth Management, and particularly those using our care investment process. For anyone else watching this, you shouldn't rely on anything in here, and you should get advice that's specific to your own circumstances. I'm going to cover some of the key economic news, the market updates, the returns as usual. Talk more about vaccinations and COVID. It's hard to get away from that. It is still the number one topic of conversation everywhere we go. I'm going to talk more about that. There's been talk of inflation emerging and what that might mean for interest rates. We're going to have a look at whether we should be scared of inflation. And I thought I'd have a look at Australia's fastest growing suburbs when we get to the property section. And as always, my goal is to put in perspective what's happening in the world back to your investments. So let's have a look at the news. So generally, the economic news is good. We've seen, and you can see from some of these charts down the bottom, the PMIs, which is the Purchasing Managers Indicator, which is a key signal of upcoming growth, is come back. It's come off a little bit, but there's still very good numbers that indicate good growth ahead. You can see the economic activity trackers, and this is a tracker that's based on weekly data for job ads, restaurant bookings, confidence, mobility, credit card transactions, etc. So it shows that we're literally back at good economic levels post-COVID, certainly well above in Australia. US is back, and the Europe zone not too far away. So good economic news continues. The share markets continue to rise. We've had talk of inflation worries, but the Fed during the month came out and reassured that they believe the inflation that we're seeing is transitory and that it will subside. And there's some merit in that. There's always debate on these things. There's some people saying, no, look out, we're coming up to runaway inflation. I don't think that's the case. You can never rule anything out. But yeah, we'll talk more about the Fed and that as we go through. Property prices just continue to go crazy, driven particularly by low interest rates, as you would expect. I'll touch on that. And vaccination rates are climbing around the world, a bit slower in Australia, but the recent COVID outbreaks have caused people to get, some people to start getting vaccinated a bit more quickly. And we've had these little spot fires breaking out around Australia when it comes to COVID cases. I'll touch on that as well. In terms of the numbers, interest rates, etc., not much changed. 10-year government bond rates are actually a bit softer this month, 1.5%. So, it's incredibly low. When you look at term deposit rates, CBA's advertised term deposit rate is 0.3%. You can get specials at 0.35 and 0.4, but it's still such an incredibly low rate, and one that's not sustainable for retirees to have all their money invested in. No change in inflation. That's a quarterly number for us, so it won't be updated till the end of June quarter, which will happen by the time we're talking next. And not much movement in the Aussie dollar at all there as well. So the returns still good and consistent. 1 month returns are very healthy. May was a good month, and you can see that flowing through to the long-term returns are still as we would hope and expect. Our long-term targets shown here, and you can see the care portfolios delivering that quite comfortably. We've upgraded our view of the market by 1 notch on our dial. We believe the market to be in that range of fair to expensive. Now, that never means that you shouldn't be buying or you should be selling. It just means the market's a little bit expensive. One of the key reasons the market's a little bit expensive is interest rates are so low. So as I just saying, 0.3% in a term deposit. You get a 4% dividend out of the share market. And I'll talk a bit about dividends. There's nowhere to invest really, except in share markets that carries a decent return. And if we think interest rates are going to stay reasonably low for a long time, then markets are a pretty fair value. If we think they're going to go up quickly, then maybe they're expensive. If we think they're going to go up slowly, then, which is what we would believe, then they're in that fair to expensive range, which is nothing to be scared of, either as an investor getting into the market or as an investor who's already in the market. So as usual, we try and put this in context using our wall of worry framework that the market goes through these three big phases: boom, bust, wall of worry. We saw the bust earlier this year, and we've seen that now come back completely. So we are now well ahead of where we were. So that cycle is completed. So that is officially the fifth biggest decline since 1900 in 120 years, and it declined by 36%. It's the fastest major decline, and it was also the fastest recovery, and driven predominantly because it wasn't a normal cycle where we had the boom followed by the bust. We were just wandering along in the wall of worry when we had the health crisis, and that's caused the decline as economies were shut down and as the world's responded with all the things we've talked about, with stimulus, with vaccines and everything else. The share market, which is always forward-looking, has recovered quickly. Just on the vaccine rollout, this chart from Our World in Data shows vaccination rates. This is people who've had at least one vaccine dose. Obviously, some of the vaccines require 2 doses, particularly the ones in Australia. Australia is not shown on this core chart, but we are sitting at about 20%. And that's gone up fairly quickly for us. So I think we're about 6 million people, 6 to 7 million people vaccinated, and going up fairly quickly. Now, I've shown some charts on the right on the UK's experience because I think they're fairly insightful. And these charts come from our friends at AMP Capital. So you'll see that this shows the UK cases and deaths since the COVID started. So you'll see, initially the light blue line which is on the right-hand scale, is the new deaths. So that's deaths that are happening. And the dark blue line, which is the scale on the right, is COVID cases. So the UK's had 1, 2, 3 waves. They're actually starting a little 4th wave at the moment. But note what's happened in this 4th wave is that the death rate, the new deaths hasn't climbed at all. So deaths incredibly low as COVID's climbed a little bit here, and that's completely because of the vaccine. You'll see that line down starting in January is when the vaccine rollout began, and you'll see that also the number of COVID cases requiring hospital occupancy, which pretty much tracked COVID up until the vaccine started, has now plummeted. So while we're getting so this is ICU in the light blue and the hospital occupancy in the dark blue. And if you line that up with vaccines starting, pretty much once the vaccine rollout was progressing in the UK, the number of cases. So if we look at the bad things, people dying, people needing to go into ICU, people needing hospital, they're not going up even as cases are going up, and that's because of the vaccine. So highly critical that vaccine rollout continues around the world. We've had that case in point. As I record this, there was some news yesterday that the New South Wales outbreak, there was a party known as the West Hoxton Party that 30 people attended, and 24 of them caught COVID. But here's the important thing. The 6 that didn't had all been vaccinated, including some that were only partially vaccinated. So that news is still updating, so don't quote me on that being perfectly accurate. But it's pretty insightful in the fact that if you're vaccinated, you're less likely to catch it, you're less likely to die, you're less likely to go to hospital, and you're less likely to end up in the ICU. And it is the only way forward if we're to open up. In Australia, no one has died this calendar year from COVID. So we had our deaths go up, and it's a pretty small number of deaths overall when we compare. We're not diminishing any death that happens from any cause. It's a tragedy for family, friends, etc., and of course those dying. But we've had no deaths from COVID now in this calendar year, and hopefully, if we can increase our vaccine rates, we'll maintain that pretty much. The last deaths were back in December, and we've had a complete decline in that since about October last year. This is the new cases in Australia, state by state, and you can see what I call these little spot fires, little things breaking out, and they've pretty much resulted in these snap lockdowns. Now, we can debate whether these snap lockdowns are useful, useless, overkill, etc. But I do liken this to one of my biggest worries about COVID is we've allowed the media and the governments to build a cage effectively to soften us up to allow for the easy control of the population. And I like this cartoon. And it says there's a bird in a cage who's saying, so then I had them build me a cage. And I really like it. Now I'm safe from cats and no one can sneak up and hurt me. And his friend who's uncaged says, but now you can't fly. And I feel like we as a population have become used to this cage that's been imposed in terms of travel and other restrictions that has pretty much happened because of media and particularly state governments controlling the agenda here. All the health experts that are guiding this are employees of governments, and we get little input from private enterprise, which is really suffering. I do have some worries that these snap lockdowns are hurting small business. They don't affect anyone that works for the government. As I came through quarantine last night, coming from New Zealand, there was more quarantine workers than people coming off our plane. And it dawned on me, it was quite obvious that all those quarantine workers work for the government, and there's been no layoffs in the government. And this is one of the reasons that we're not worried about inflation, because there's still all that capacity in the private enterprise. But yeah, my message there, get vaccinated. And I do believe in freedom and all that stuff, but I believe the only way forward to get an open economy, open travel, and get the world back to some normal is with vaccination, where COVID just becomes another flu. We're never getting rid of this. We don't need to be scared of it with vaccinations. And I'm not a health expert, so discount everything I say. But yeah, I'm very interested in studying this on the impact it has on markets. So inflation, should we be worried? Let's have a look at a bit of history, as always. If we look at, I've put some yellow lines in here. Here's our index chart. On the dark blue line is the share market. And the yellow space here is inflation. And we had, going back to the 1950s, low inflation. It's sort of stepped up slowly after the war, when we had massive stimulus post-World War II. And then we had the oil shock in the 70s, and it went up dramatically. Couldn't get it under control, and then slowly started to break the back of it in the 90s. But you'll see the first point here is that markets generally perform stronger during inflationary times. So low inflationary times on the left, high inflationary times, higher market growth. In fact, the highest share market growth and property growth in Australia occurred during the 70s and 80s, when inflation was high. And then since we've broken the back, share market return has been relatively low. And that's why I always talk about inflation plus when I'm talking about investment returns. And the share market has consistently done inflation plus 6% over time. Not every year, it's obviously varies a lot. Now, one of the fears is that rising inflation leads to rising interest rates, and that can lead to recessions. And that's partially true. So you can see the red arrows that I've put in here are where we've gone through periods of rising interest rates and rising inflation. That's led to rising interest rates, and that's led to recessions. And that's where the Federal Reserve and the reserve banks are putting the brakes on fast-moving economies. Now, we don't have a fast-moving economy at the moment. We've still got a very slow moving economy. They're trying to ignite that. The risk is they ignite it too far. We get growth, bring that on, by the way, but then they put the brakes on and we get a bit of a recession. So that's all to play out. We're still in the low growth world, so it's not something that we're too worried about. It'll happen if it happens. And the other point I'd make is that current interest rates are at record lows. This is the 30-year bond rate in the US, and you'll see from a high of 14+% in the 80s, it's come down to a low of about 1.4%. Yeah, and even with inflation being nicely targeted in a perfect world at 2.5%, which is the target of both the Federal Reserve in the US and the Reserve Bank in Australia, you would expect a normal bond rate to be at 4%. So we're at abnormally low rates, so we can actually handle some rates going up into the normal. What we don't want, and what the worriers are worried about is inflation going up too quickly, which doesn't look likely at the moment. In the congressional testimony by the Fed chair, by Powell, this month, we saw him say that he iterated that the inflation spike is likely to be temporary, and there's a long way to go on employment. What he's saying there is there's still people looking for jobs, and that means there's capacity in the economy, so we're not likely to see that wage pressure. Important to note that during the 70s and the 80s, one of the things that kept inflation in the system was the expectation of wage rises to match inflation. At the moment, we have the complete opposite. There is very low expectations of wage rises. Now, if that creeps into the system, that will be dangerous, but there's no sign of it as yet. And sorry, just to go back down, sorry. So the Fed is talking about first rate hike probably in 2023. The RBA in Australia is talking about it in 2024. So, considering we're in the middle of 2021, it's still a long way away. So these worries are predominantly probably early, too early. There's an old saying in the markets called "Don't fight the Fed." In other words, the Fed is the one that controls the money supply and ultimately interest rates. They don't have complete control about it, but it's good to watch what they say as a guide. So no worries there. Just reiterating our process, which has worked beautifully during this crisis. And I will say again, I fear that the media, combined with these state government restrictions, has created this cage that we're living in. We're seeing a bit more of that at the moment. And I've never in my 35 years in the markets have I seen such a short-term focus on one single issue. But the market's holding up incredibly well. So let's get into what the markets have done. And the Australian share market had a good month, up 2.31%. You can see it's gone even higher there. That's the closing price of VAS, which is how we hold Australian shares. So the market went up a bit further after that. It's come back a little bit since, but it's kind of healthy when the market retreats a bit, going up too quick. You can see the bottom of this chart shows the last 10 years. So in the last 10 years, someone that invested $60 in the share markets, even though they went down initially, that's now worth about $90+ plus they've received 4.2% in dividends on average during that whole period. So an extremely solid performance. Down the bottom here, you can see the top 10 holdings that make up the ASX 200, but also VAS, their one-year returns and their price earnings ratios. And you can see a massive contrast. We've got the mining companies, BHP, Rio Tinto, with very low price earnings ratios. Price earning ratios are just where the multiple of earnings. So you can buy them on single digits, and that's a reflection of the fact that the market believes iron ore prices will drop, and they're abnormally high, which everyone's been saying for a couple of years, but it keeps staying higher. And certainly the Australian government, as I mentioned last month, also predicts iron ore to drop. The US share market in Australian dollar terms up about 0.23% for the month. It flew higher since, dropped a little, but has rebounded back from that, particularly after that reassurance from the chair, from Powell, the head of the Federal Reserve. It has also had a spectacular 10-year return, and you'll see that return there almost, a triple over the last 10 years. Lower dividend rates, but still 2.24% on average over that time. And this is why we don't just invest in Australian shares, why diversification is so important. US small caps, so that's the smaller end of the market, still includes quite solid companies. I note that Macy's is in there. If Macy's was in Australia, it's a market cap of 411 billion. If we go back to the Australian companies, Macy's would be just outside our top 10. So what's considered small cap in the US is only just outside our top 10 in Australia. And good return for small caps. Quite spectacular over the last, we see the 3-year return there. The 1-year return, 47.8%. So massive 1-year return and very solid over the last 5 and 10 years as well. Global leaders, that's top 100 companies in the world. That's people like Apple, Microsoft, Google. The big JP Morgan, Nestle, Procter & Gamble, Johnson & Johnson, all enjoying great 1-year returns for the most part. and market's gone up since then. So it looks like we're going to close the year, when the financial year closes tomorrow, on a positive note, and certainly very strong returns over the year. Emerging markets haven't done as well, but still fairly solid. A positive month, up a little bit, but they tend to follow leading markets, and you'll see them catch up. And emerging markets in the long run do outperform the big cap, the big European, US, and Australian markets. You see some interesting companies there. Companies like Alibaba, which is like the US, like the Chinese Amazon. Tencent, Samsung out of North Korea. So some very big companies there with some big market caps as well. Gold still in the portfolio. Gold had a positive month. It rose strongly, up 7%. The rise was on the inflation fears that I talked about, but you can see now that post the close of May, the heat's gone out of the gold market, which tells you the market isn't worried as much about inflation. This will be an ongoing battle that we'll see come out in the next months to years. This worry about when do interest rates go up, when does inflation go up. But as I said earlier, not something that I would be overly worried about. It will cause volatility in short term, but if inflation does come back, and we do need some inflation, then that leads to increasing profits, increasing rents, etc. Property market, look at this sea of green. When you look at houses in the middle here, all up, Darwin 21%, Adelaide 13%, Sydney 14%. And this is the median prices for the whole of those cities. And this is just capital cities. I'm going to talk about regional Australia in a minute. You'll note that the unit increase is not as high. So units haven't gone up by as much, and that reflects the flight to people wanting to live in comfortable houses, particularly if they're working from home and not commuting to work as much. And this is a major trend that's probably changed forever. That people have more flexibility about their work because employers have seen that people can work from home and they don't have to worry about it. So we're going to see that more and more. Have a look at the top 10 suburbs. So I've put in here the top 10 suburbs for New South Wales, Queensland, WA, and Victoria. And in nearly all these cases, they're regional suburbs. And I've ordered this by the 12-month growth. And you can see around Australia, the top in each state nudging 50% over 1 year. And in Queensland, that's Airlie Beach. Now, Airlie Beach had had a terrible time the year before, so it would have been off a low base. Airlie Beach has a lot of luxury property, and luxury property has done incredibly well, as has good old boring beach towns. And look at good old boring Toowoomba, a rock solid big city. It's up 37%. But most of the places here, there's Bar Beach in Newcastle, up 45%. Mossy Point down the south coast of New South Wales, the Entrance. So most of these are regional lifestyle places that have seen incredible growth. And when we look at Melbourne, the only suburb I can see there that's when we look at Victoria, the only suburb there's East Melbourne, up strongly. And the same thing in WA. So rural areas for the most part there, West Busselton, Mount Barker, Preston Beach, gone up. You see a wide variety of median prices there. Look at Bar Beach in Newcastle, 3.4 million, one of the most expensive suburbs in Australia now. Certainly the most expensive suburb in Newcastle. Fascinating. So everything rising. So the property clock, same as last month, pretty much everything rising. Heron Todd is saying some of these, a handful of places, maybe at the peak of the market, but everything else is rising and showing no sign. Although I feel like we've probably seen the most of that gain. It's going to be interesting to watch. Units the same, but much lower returns, as we talked about before, and potentially opportunity there. One on the other side of COVID, when we get immigration growth back, when we get foreign students back, and when the inner city units fill up again, we'll probably see some growth there. Just want to close by reinforcing, as always, our approach. So goals first, based on what's important to you and your life. All investing best done as part of a real financial plan. The portfolio is designed to meet those goals, and we take a long-term view. We're very interested, as you see each month in the short term, what's happening, but our goal is to put that in perspective for the long term, which is where we make our real returns. Diversification, asset allocation, liquidity, boring stuff, but it's the keys to the success of the portfolios, and low-cost index for most of that. We protect against the short term. volatility by holding enough reserves for our retired clients and by dollar cost averaging for our clients that are still building their wealth. And we rebalance regularly, which adds value over time. And as always, there's only 3 ways to lose your money in the market, and don't do them. Congratulations again to all our clients. We've had no panic, no worries during this craziness. No one forced to sell, and that's meant our clients, you guys, have enjoyed good returns. And those 3 ways: panic and sell, have to sell because you need the money, or not properly diversified. Thank you for your attention. If you made it this far, I'll be talking to you again next month. We are moving, watch our emails coming up, but we're moving to a ground floor spot over near the Noosa Hospital. So that's the Noosa office, moving there, not too far for most people. Easy access, plenty of parking. Watch our emails, you'll get those shortly. And look forward to seeing you soon and talking to you next month. Rob McGregor signing out.